Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group, and today I have the pleasure of sharing with you our 2022 market outlook. Now there's some really interesting trends that are starting to develop in the economy and the markets, trends that investors have not seen for decades because inflation is starting to heat up and we really have to go back to the 1970s, which is the last period we had meaningful inflation, to determine how did that impact stock returns, bond returns, commodities, cash, to get a point of reference as to how we might structure portfolios going into next year. And investors have the general questions of, do we expect the stock market rally to continue into next year? With inflation heating up, is that going to potentially derail the economy at some point? Also, the Fed, recognizing inflation, has telegraphed that they plan to make rate increases next year. How is the market going to potentially react to that? One of the other items we're going to go over is, because tech stocks have been such a hot item in the market, we're going to give you a history lesson in what's called the Nifty 50, which were the hot stocks back in the 70s, and how those stocks reacted to inflation, as well as talking about labor shortages, supply chain constraints, and how overall we think the markets will trend going into next year. In general, we expect the economy to continue to gain strength in the first half of 2022, mainly because the U.S. economy is based largely on consumer spending, and the consumer is very healthy right now. They have cash in the form of higher wages. A lot of companies have had to pay more in wages to retain employees and actually attract new ones. And also, many of these consumers have received these government stimulus payments over the last 18 months, and they actually haven't been able to spend them because the goods and services haven't been there to spend those dollars. So what some of these consumers have done is, instead of spending, they have paid down debt. And if you look at this chart, we can see that this is a chart of the household debt service ratio. And if you look over here on the right-hand side of the chart where we're at in 2001, households are at the lowest level of debt that we've seen in 40 years, which is encouraging going into 2022. When we're out there talking to businesses, a lot of businesses are telling us we have the record level of backlogs we have ever had in the company. And all backlogs are is clients have come to them, said, I want to buy whatever you offer. And they say, we don't have it now, but I'll take your deposit and put you on the waiting list. So some of these companies have backlog orders for 3, 6, 9, 12 months or beyond. So it's one of those where they know the sales are there. It's just when they're going to be able to deliver to the client and collect the revenue, which gives us some more stability, because it becomes not an if the sales are going to be there, just a when the revenue will get recognized. When we try to answer that when question as to when those goods will ultimately be delivered to the clients, we have to look at the supply chain constraints that we've seen, and do we expect those to ease in 2022? Now, what caught the market off guard is people did not return to the workforce as quickly as the market overall expected. If there aren't people at the ports to unload the ships, if there's not truck drivers to transport the goods from the ports to the stores, and if there's not people at the stores to stock the shelves, it's tough for the consumer to spend and obtain the goods and services that they're looking for. There are three main trends that we see playing out in 2022 to help ease some of these labor constraints. The first is individuals that receive large stimulus payments for the government may be drawing down on those cash reserves, but once those cash reserves are depleted, they will be forced to return to the workforce. The second being, employers may be offering higher wages or signing bonuses incentives to bring people back now. And then third are the easing of the child care constraints. If you have a child at home and they have a cough and they get sent home because of COVID, usually a parent might have to leave work or stay home for a few days while the child's quarantining. That has prevented a lot of parents from being able to fully re-enter the workforce. Because the labor trends are already improving, there are a lot more goods entering the U.S. even within the last few weeks. The two main ports in the U.S. are the Port of Los Angeles and the Port of Long Beach. Between those two ports, that's where we get 40% of our goods by sea. And they just did an interview of the executive director of one of the ports, and he said in the middle of November, there were 111 ships buoyed off the California coast. And within 2 weeks, towards the end of November, there were only 61. These ports are working around the clock to bring goods in, get things on trucks, and get them in the store, so the situation is improving. One of the largest catalysts for growth going into 2022 is just the sheer magnitude of the amount of cash that has been injected into the economy over the last 18 months. And the only way I can really quantify this is kind of comparing the COVID stimulus programs to the stimulus programs that happened back in 08, 09. during the Great Recession. So if you look at this visual, we have TARP, which was the stimulus program that bailed out the banks and the housing market in 0809. That was $700 billion on the left-hand side. If you look on the right-hand side, these are the multiple stimulus programs that were issued between 2020 and 2021, and that grand total, so back in 0809, it was $700 billion. The total for COVID was $7 trillion, which is 10 times the stimulus amount from the 0809 Great Recession, and that does not include the Build Back Better bill, which they're trying to get through Congress right now, which is another 1.75 trillion. The other way we can measure the amount of liquidity in the system is by looking at the M2 money supply. So look at this chart. So this shows the year-over-year change in the money supply going all the way back to 1980. And if you look on the right-hand side, this is where we are now. See that mountain spike up? Like, you can look back in history, there has never been a time in history where they have injected this much liquidity in the system, and a lot of this money has yet to be spent. In our view, the greatest risk to the economy in 2022 is obviously inflation. Inflation. We have all seen the price on everything that we buy go up. Gas, food, travel, you name it. And it hasn't gone up by small amounts. It's gone up by fairly large amounts over the last 18 months. So the question then becomes, going to next year, is this temporary inflation, meaning as the supply chain gets back online, will the prices stabilize and potentially go back down? Or is this inflation trend just the beginning and prices could go higher and potentially derail the economy? Unfortunately, the answer to that question is it's too early to tell. We have to wait to see how quickly the supply chain comes back online, and if it does in fact ease prices and put inflation at bay. If the supply chain doesn't come back quick enough, or even if it comes back and inflation still persists, this could be a completely different animal we're dealing with in the second half of the year. And I keep saying second half of the year because if people have money, the real risk of inflation is prices go up to a level that people can no longer afford, meaning it decreases the amount of consumer spending. As long as people have cash and they can afford to pay the higher prices and it doesn't deter them from spending, inflation doesn't damage the economy. It's only when you get to those later stages where prices go too high that then it can really unravel things. So we have yet to see. In the first 6 months of the year, consumer seems healthy, they have cash, they may be able to, absorb some of these higher prices, where later in the year, depending on where inflation goes, if they go too high, that's where we could run into issues. We really have to keep a close eye on Fed policy next year because the Fed is going to have to respond to these higher inflation rates. They already have and changed their stance a few times, but the Fed's primary objective is they want to create full employment in the economy and they want to keep inflation within their target range between 2 or 3%. And the inflation readings that we've gotten more recently, if you look at this CPI chart, which is a consumer price index, the inflation rate has gone well above the Fed's comfort range. So they've already changed their stance. They've announced that they plan to taper their bond purchases sooner. And as of the last meeting, they intend to hike interest rates potentially 3 times in 2022. This change in the Fed's stance does not necessarily mark an end to the economic recovery. By raising rates, they are essentially trying to tap the brakes on the economy so it doesn't completely overheat. And while it sounds bad that they're trying to slow things down, what history has shown us in the early stages of a rate hike cycle, as long as those rates are in small incremental amounts, maybe quarter point raises, it usually will not derail the economy because the economy has time to digest the higher rates. So think of it like a mortgage rate. So if mortgage rates right now on a 30-year are like 3.25% and they increase to 3.5%, that might slow things down a little, but it might not slow things down a lot. Versus if the mortgage rates go from like 3.25 up to like 5%, that's kind of like slamming the brakes on the freeway, and it could really hurt the housing market and create a lot of other negative events to transpire. The other topic I want to address is how inflation could potentially impact some of these high-flying tech stocks we've seen in our markets over the past few years. And actually, there's a lot of similarities. If you go back to the 1970s, they had a group of stocks called the Nifty 50. So those were their kind of darling stocks of that era, that it was one of those, how can they ever go down? And they dominated the market. So coming out of the 60s, there was a big bull rally. So a lot of these Nifty 50 stocks, which at the time were like McDonald's, IBM, Johnson & Johnson. So these were those stocks at the time. They were allowed to trade at much higher valuations because they were the big growth engines of that time. But then inflation showed up and it all changed. When inflation showed up in the early 70s, a lot of these Nifty 50 stock prices dropped by over 60% in a really short period of time. And again, if inflation shows up and interest rates go up, the stocks that trade at a higher multiple get punished more because all of a sudden everyone starts caring about valuation. So when we look at, back then those PEs and those stocks were over 50. We have similar tech stocks in our market now like Netflix and Amazon, which also trade at a PE over 50. Could there potentially be similarities? To be clear, I'm not recommending that everyone go out and sell all their FANG stocks. It's more about, since we haven't been in an inflationary environment in a long time, looking back through history to trying to assess that if we're holding stocks and portfolios that have higher multiples and interest rates start going up, how they may be impacted so we can properly assess risks, opportunities, and investment decisions going into next year. When we bring all these variables together, we really look at the 2022 year as a year of two chapters. So we have the first half of the year, which we expect strong economic growth, but there's going to be more volatility. As the Fed actually announces their rate hikes and puts these things into action, you could see multiple sell-offs throughout the year that investors, it could test their patience, that they could have to hold through, but it also might present an opportunity for investors to put cash to work because we haven't seen that many sell-offs in 2021. The second half of the year to us is all about the inflation trend. If inflation does not subside or continues to run hotter than expected, it could start to decrease the purchasing power of the consumer or cause the Fed to raise rates more than they expected going into 2022, which could harm the economy. Overall, investors are just going to have to pay closer attention to the inflation and economic data as it comes out week by week, month by month to determine where we are in the economic cycle and if any pivots need to be made. I hope this is helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.